The Bank of Canada has lowered its policy interest rate by 25 basis points to 3%, while cautioning that the economic repercussions of an ongoing trade war with the United States could be significant. This situation could hinder growth and potentially reignite inflation. Bank of Canada Governor Tiff Macklem stated that while inflation has remained close to the bank's 2% target since August and household spending is increasing, the uncertainty surrounding a trade conflict with the United States has clouded both the economic and inflation outlooks. A prolonged and widespread conflict would severely damage economic activity in Canada, Macklem explained. At the same time, the increased cost of imported goods will exert upward pressure on inflation. In its benchmark calibration, which predicts price changes in line with previous tariffs, a 25% U.S. tariff on all imported goods, coupled with equal retaliation from trading partners, could decrease Canada's gross domestic product (GDP) by 2.5 percentage points by the end of the first year. Another scenario suggests a greater decline in U.S. demand for Canadian goods, which would result in a 3 percentage point hit to Canadian economic growth. All scenarios indicate an increase in the Consumer Price Index (CPI) inflation for both Canada and the U.S. over a 3-year period. Unfortunately, tariffs cause economies to operate less efficiently. We produce and earn less than we would without tariffs, Macklem noted. This creates a complex situation for monetary policy, as we face weaker growth and higher inflation, he added during a press conference with reporters in Ottawa. David Rosenberg, founder and president of Rosenberg Research Associates Incorporated, mentioned that futures markets are currently pricing in only a 60% chance of another rate cut in March. James Orlando, senior economist at Toronto Dominion Bank, expressed hope that the tariffs are merely a negotiation tactic. However, if implemented, he believes the central bank would need to cut rates more aggressively to support the economy. Our baseline forecast remains that the Bank of Canada will reduce rates to 2.25% by the end of the year. However, if 25% tariffs are in effect for more than a few months, we would expect the central bank to respond with more significant cuts to cushion the economy. The Bank of Canada's decision to cut its benchmark lending rate by 25 basis points to 3% was widely anticipated by both investors and economists. However, the future remains uncertain given the prospect of an ongoing trade war with the United States.